at the $1 billion question. The valuations look relatively high across a number of stocks. I mean, you still find some potential value places. On a relative basis, maybe Europe looks less of a value than the US, but then you've got to look into what is making up the valuations of US stocks versus what's making up the valuation of European stocks. So I'd say that you don't necessarily want to be too much underweight. You want to be to be gearing your portfolio for a slightly more neutral stance from that standpoint, while you wait to see. Obviously, we've got some very strong economic data. We had some impressive ISM numbers. We're looking to see what the non-farm payrolls will be today, but ADP numbers are relatively positive from that standpoint. So the key question is, when you move into the next quarter, what is going to drive that performance? How much of that has already been priced in? The good thing, though, is that you've got a lot of liquidity. There's a lot of investors which have been sitting on the side. From an ETF standpoint, we haven't seen a lot of inflows into equities. We've seen a lot of inflows into fixed income and more into corporate bonds than into treasuries, to the former question, actually.
I'm glad you mentioned corporate bonds. It's almost as if you read my mind, Antoine. Good morning to you, my friend. Look, you have begged the question in your latest copy. Why invest in junk? Sorry, why invest in high-yield bonds as well? A little slip of the tongue there for me. I'm asking the question, why would you go near it in the current environment? If anything's still high yield, doesn't it smell a bit?
It's been doing so for quite some time, and I think it's really a question of how do you go there, how careful you are about your defining your index, defining your environment, but also thinking about what is one of the potential support for this market, and the potential support for this market is further stimulus, a relatively accommodative Fed, an accommodative ECB, and the fact that some of those fallen angels also have the backing of the of those central banks. So from that standpoint, I wouldn't say all of the bad news is fully discounted into the spreads, but if you're looking for a little bit of carry strategies, and not all the companies are going to default in that environment, you're relatively well protected on a relative basis versus this market. Now, you've got to be careful, again, to make sure that you are diversified and you apply a certain numbers of risk management tools, whether it's capping the weight of each issuer in the portfolio, or finding or setting a minimum rating floor, for example.
Antoine, stop reading my mind. I was going to ask you about default rates, and you've already mentioned them, but I'm going to ask you again. Default rates. It was old-fashioned of me, you and Jeff back in the day to look at default rates as a barometer for the investability of high yield as well. Do we still bother looking at that, or is just the Fed and everyone got their back too much that we don't need to look at them?
I think we should still look at those. Obviously, the forecasting of the economic numbers has been relatively challenging in the past few months. Obviously, we've had unprecedented levels of trough and then rebound. Usually when you go into bankruptcy, because you've called the names junk, and the story I think it's in one of Hemingway's novel called The Sun Also Rises. He said, I went bankrupt relatively slowly, and then all of a sudden, give me some rope in terms of quoting this, but this is clearly what's happening for the high yield market and for a number of bonds in this environment. Now, what the Fed and what the ECB are doing is that they're slowing potentially the pace at which some of those firms could be collapsing. And yes, we've had those discussions actually on this program before about zombie companies being funded by those authorities, but at least it's slowing the pace of the pace at which the defaults could be coming in. So from that, in between, there is a little bit of a carry opportunity to be taken during, for example, the summer, as you've got less issuance in the summer and you've got a little bit of a technical spread contraction. If everything goes okay and that the news flow is not too bad, spread compression on that segment as well.
Antoine, let me ask you about gold. It's become the consensus must-have for the second half of the year here. But I'll just remind our audience that when we got the big sell-off back in March, gold also got sold down. So it doesn't always stand up in the face of extreme public anxiety or market anxiety. Just walk us through the argument for adding at this price? Because we've come a long way and we're running into the second half. And if we do have anything that looks like a recovery and a vaccine from any of these companies that are now in early stage development, is gold going to hang on to these gains?
That's a fair depiction in terms of the potential risk of holding gold. And one of the things in terms of the asset allocation of investors, and some of the investors within our group as well, has been to add to gold during the crisis. Well, after the fall in March, and use it as a dampener in the portfolio. What you saw, if I can come back to that to that point in the month of March, there was a little bit of a liquidity question. So what was the asset that you could sell the most quickly in your portfolio to meet margins, to dash for cash? And gold was one of them. Now we're in a different environment from that standpoint, where the central banks are there. The liquidity risk has gone away to some extent because of the massive amounts of promises from the central banks that have been done, and actually actions that are being taken at the moment. So from that standpoint, the question of how much gold, how much higher gold should go, or is it a good tool to have in your portfolio? I think it still goes back to more the more traditional kind of buffer in the portfolio. And yes, the numbers are good, but also you're starting to see. I mean, the numbers are. We're looking at June numbers or May numbers in terms of all the economic data. You've got a different situation, panning out in the market as economies reopen and as COVID numbers or COVID cases continue to increase. So you still want to have a little bit of that protection in the portfolio to some extent. Maybe not as much as you wanted to have it, say, a couple of months ago, but you still want to have some exposure to gold in your portfolio as a diversifier. The last question, obviously, is it's also a protection against inflation that could be triggered by those amounts of liquidity, but it's not my main concern right now.